Learning objective 4-6. Understand and explain the elimination of basic intercompany transactions. So there are certain kinds of transactions that may occur between a parent and a sub or between affiliates that from a management accounting perspective make a lot of sense. And if you're looking at each subsidiary or parent, each entity separately may make sense, but from a consolidated perspective does not make any sense at all and is not in compliance with GAAP. And these are the types of things that you learn about in management accounting. And for example, a good example of this are intercompany reciprocal accounts. For example, you may have um, you may have a receivable. One entity may have a receivable from the other, and the other entity has a payable to that one. So one company is going to have a payable. Let's say the parent has a payable to sub, and the sub has a payable to parent. And if you're lucky, they're for the same amount. They're for the same amount. As a side note, my own professional accounting experience, I did a lot of experience with not-for-profit organizations which use funds accounting, and each fund is like a separate company. And I had one client that had about 20 or 30 different funds, and there were intercompany transactions all over the place. The typical fund had intercompany payables or receivables to 13 or 14 different entities. So you could imagine when you have 30 or 40 entities with so many receivables back and forth between all of them, you have to make sure that they're equal. If one company, if the subsidiary owes the parent a certain amount of money, then the parent better have a receivable for that same amount. Those are called intercompany reciprocal accounts, and they should be equal again. And when you consolidate, you're going to need to eliminate. In other words, you'll need to debit the payable and credit the receivable in the consolidation so they don't show up in the consolidated financial statements. You may also have, and we're going to be looking at this in this course, inventory transfers in Chapter 6. The way that works is, and you learned about this, I hope, in cost accounting, where one entity sells inventory to the other. So one records a sale and the other records a purchase. And usually when they record that sale, it's at a transfer price that allows the selling entity some gross profit. From a GAAP perspective, that's not gross profit because the only way you can record profit and a sale is by selling to an outside entity. So if you sell to an affiliate, you haven't met the criteria to recognize revenue, and therefore it's not a sale. Nonetheless, if you consolidate, this sale will come out, and in fact, if the entity that bought the inventory sells the inventory to an outside party, then you'll actually be able to sell the inventory twice. If you just consolidate and you adjust for that, that's what's going to happen is you'll be recording each sale twice. And there'll be some improper profit recorded by the entity that had the intercompany sale to the other entity. So that would also need to be eliminated. Another possibility is to have fixed asset transfers. This would be a situation where one entity sells fixed assets at a gain or a loss to another related entity. So for example, you may have a parent sell land in a building to a subsidiary and record a gain. Well, from a GAAP perspective, that's not a gain because you can't book a gain on a sale to an entity that you control. You would need to eliminate that in your intercompany consolidation. And finally, intercompany indebtedness, Chapter 8. And I'm recording this video in January 2019. So in this particular semester, we're covering Chapter 6, not 7 or 8. Sometimes I alternate and cover Chapter 7 instead of 6. This semester, I decided to cover Chapter 6. Anyway, intercompany indebtedness, I used to teach that too, but I stopped covering it a while ago. That would be a situation where one entity holds bonds that belong to another entity. So one entity issues bonds to borrow money from a related entity. So one company is going to have bonds payable, and the other company is going to have an investment in bonds. And again, that's going to need to be eliminated. And the way to think about these things is that companies can't really, you can have a parent pay money to a sub pay money to a parent, et cetera, But from a consolidated point of view, we look at everything as one company. And if we're going to look at everything as one company, then these transactions are not real. And therefore, there should be no sign of them at all in your consolidated financial statements. So if your sub owes money to the parent, that may be a liability on the books of the sub, and it may be a receivable on the books of the parent. But in the consolidated financial statements, it should not show up. And therefore, when you consolidate, these are going to need to be eliminated by debiting the payable, crediting the receivable. And these other transactions here, inventory transfers, we'll cover in Chapter 6. If you're interested in fixed asset transfers into company indebtedness, then take a look at Chapter 8. There's a little exercise here. I'm not going to go through the whole thing, but here you can see what this would look like. In your consolidation, you would debit the note payable and credit the note receivable. And again, I always say this is phrased as a debit credit transaction like in a journal, but this would be on your consolidation worksheet. It would not show up anywhere else. Similar interest payable, interest receivable, interest revenue that's recorded by the parent, and interest expense that's recorded by the sub would also need to be eliminated.